Mike, maganda yung kanina, no? Ha?
Hi, Attorney Francis. Good afternoon.
Afternoon. Are you dyan?
Hi, boss. Okay lang naman.
Ka, boss. Kilala ko ito, ah.
Thank you, thank you.
Thank you, Jan. Rafi, thank you.
Friday sa Senate, ano?
Sorry?
Friday, sorry ah.
Hey, Romy, thank you, ah. Boss. 2 webinars in one day.
Alex, we can start. Hi, good afternoon and welcome to the Ground Briefing 2021 on global and Philippine market developments and outlook, the impact of the vaccine rollout. We'll start with our invocation. Please join me in prayer, bow down our heads, and acknowledge the presence of the Lord. Loving Heavenly Father, we come to you this hour asking for your blessing and help. As we are gathered together, we pray for guidance in the matters at hand and ask that you would clearly show us how to conduct our work with a spirit of joy and enthusiasm. Give us the desire to find ways to excel in our work, help us to work together, and encourage each other to excellence. We ask that we would challenge each other to reach higher and farther to be the best we can be. We ask this in the name of the Lord Jesus Christ. Amen. Please join me in honoring the flag. Thank you very much. May I now call on the Phoenix President, Attorney Francis Lim.
Thank you very much, Ned. A pleasant good afternoon to all of you, our distinguished guests and panelists, my fellow directors in Phoenix and our Phoenix members, friends from the media, and guests. It is my honor to welcome all of you to the PHINEX first economic briefing for the year with the theme Global and Philippine Market Developments and Outlook, Impact of the Vaccine Rollout. Last year, the global market has been shocked by the COVID-19 pandemic. The shock still continues today. Many companies were forced to close and cut costs by downsizing their workforce. Malls limited their patrons by not allowing minors and senior citizens. Tourism declined, which affected lots of hotels and resorts and the transportation industry. Economies, even the largest ones in the world, were tremendously shaken. 2021 gave us some hope by the announcement of the release of vaccine for COVID-19. It gave us some optimism that our usual lives, lost livelihood and economy would return to normal. But the global rollout of the vaccine is not easy. In the Philippines, for example, based on the recent Okta survey, only 19% of Filipinos are willing to be vaccinated. And as of March 22, the Philippines have only received 1.1 million doses of the vaccine. And out of these, 240,000 doses were given, and no one else is fully vaccinated to date. Globally, out of the 458 million doses given, only 404 million are fully vaccinated, which only represents 1.33% of the total global population. Truly indeed, a long way to go. Today, we will hear from global and local market experts that can give us the outlook and developments of the market and the impact of the vaccine rollout. We would like to thank Mr. Ray Faris, Chief Investment Officer at Credit Suisse and Managing Director and Chief Economist at APAC, and Mr. Federico Campo, Senior Vice President at BDO Unibank Inc., and the Chief Investment Officer at the BDO Trust and Investment Group, for accepting our invitation to be our resource speaker for this afternoon. We would like also to thank our panelists for today, our very own Romy Bernardo, President at Lazaro Bernardo Chu and Associates, and the Philippine Advisor of Global Source Partners, and my friend John Ong, Chief Finance Officer at SM Prime Holdings. We'd like to thank BDO Bank for sponsoring this event. Your support can go a long way into helping PHINEX. Lastly, I would like to thank our Professional Development Committee, led by Chair Paul San Pedro, Co-Chair Edith Estacio, Liaison Director Omar Cruz for organizing this webinar. Of course, many thanks goes to Mike Luan and our other hardworking staff at PHINEX. Once again, good afternoon, and we hope that you will enjoy this informative event. Maraming salamat at mabuhay ang PHINEX.
Thank you very much, President Francis. Before I introduce the speakers, just some housekeeping rules. Number one, please post your questions in the Q&A box if you have any questions, and we'll try to answer them during the open forum. We will also not be posting the materials for this webinar because of compliance and legal issues. So our first speaker for this afternoon is Ray Faris. He's a managing director, the chief economist for APAC, and the head of the APAC economics team in the investment solutions and products department of the International Wealth Management Division of Credit Suisse. Prior to this, Ray was at various times the head of fixed income research and economics, Asia Pacific Division, head of Asia Macro Strategy, head of the Global Emerging Market Strategy, head of the Asia Pacific Macro Product Research Team, head of Fixed Income Strategy for the Asia Pacific region, and head of Global Foreign Exchange Strategy based out of London from 2007 to 11. He joined Credit Suisse in February of 1998 from BZW Asia, where he was Head of Asian Economics in the Equity Division. Ray holds a degree in economics with highest honors from the University of North Carolina, Chapel Hill, and a master's degree in finance with distinction from the London Business School. Our second speaker is Federico Rafael D. Ocampo, who is a Senior Vice President of BDO Unibank. He's the Chief Investment Officer of the Trust Group and managing close to 1 trillion in assets under management. Prior to BDO, he was a director of Deutsche Bank's Asset and Wealth Management Group in Manila for 18 years. He was named the Philippine CIO of the Year by Asia Asset Management for 2012 and 2011. He was likewise recognized as the Fund Manager of the Year for long-only fixed income funds in the Assets Asian Asset Awards in 2012. In the survey of the same publication, he was voted as one of the most astute Philippine currency bond traders for several years. He completed his Master's of Science in Economics at the Pennsylvania State University as a Rotary Foundation Ambassadorial Scholar in 1994. He obtained his bachelor's at the University of the Philippines School of Economics with honors in 1990. He completed the International Baccalaureate at the Lester B. Pearson College of the Pacific in Victoria, Canada, as a United World College Scholar in 1985. He is an adjunct professor at the Asian Institute of Management and has lectured on portfolio management and fundamental analysis at the De La Salle Professional School and the BSP Training Institute, as well as the Philippine Trust Institute. Let me call our first speaker, Ray.
Yep. Hi there.
Mr. Faris, there we go.
Great. Thank you very much for having me. It's a real honor to be here. Just give me 1 second to work out the technology so that I can get my presentation up on the screen. Okay, so let's see. Can everybody see that?
That's good, Ray.
Okay, fantastic. Let me just kick off. So what I'm going to do today is take you through our, in brief, our global economic outlook, including in broad terms, the economic outlook for Asia as it's beginning to unfold due to the COVID vaccine rollout and stimulus packages in the West, particularly the United States. So let's start with COVID. There's good news, there's bad news, and then there's more good news. The good news is that as of at least a week or two ago, this is the way the world looked in terms of new infections. In most major regions, new infections, new cases of COVID were coming down. Now we know, unfortunately, that COVID moves very quickly, and that's one of the real challenges with this disease. So literally overnight, there's been news that Germany's going through something of a third wave. And that's bad news, I suppose. But in most regions, new COVID infections are coming down. The particularly good news is in the next slide, which is that we now have several, really more than that, effective vaccines that are being applied at a global level. And crucially, vaccine supply is rising very rapidly, as this chart shows. So it's going to take time for everybody to get vaccinated, and we really need a large percentage of the population, not 100%, but we need a large percentage of the eligible population to be willing to be vaccinated. And I recognize there's some issues around that, but we tend to think that vaccine supply is going to become pretty ample by the end of this year and certainly next year. Now, what that results in is, if we look at this slide, is that increasingly large parts of developed markets are going to be hitting herd immunity levels because of vaccines and the fact that a lot of people have already contracted COVID by the late third quarter or early fourth quarter. And the countries that really stand out in this regard, the US, the UK, although Europe has stumbled a bit so far, we expect them to regain momentum into the second half of the year. And so we expect Germany and France and much of other parts of developed Europe to probably reach herd immunity levels by the end of the year. And that, of course, will be, good for Asia, in that one spillover is much later this year, early next year, the developed West should start to return to travel. Now, if we then move from here into the nature of this recession that we had last year, it's been a very strange recession. So one odd aspect of that terrible fall in global GDP and global industrial production that you see in the blue and the red lines to the far right of the chart is that global industrial production has recovered much more rapidly than in past recessions. That's important, particularly for risk appetite, because we find that global industrial production is much more important for risk appetite than the services sector of economies and global GDP more generally. Why has industrial production begun to recover very rapidly, and why are we projecting it to recover more rapidly than global GDP? Well, that's because of this. Developed market retail sales, essentially sales of goods, have bounced back very impressively. So not only are they back to trend levels, they're above trend levels. The core support factor for that is that in the West, particularly in the United States, fiscal policy has been very active to support households. And so households have been trapped at home, but with ample income, even households that have lost employment, and goods consumption has gone up as households have moved to respond to COVID and lockdowns and the like, with home renovations, upgrading of electronic systems, computers, home offices, etc., to be able to navigate in this new sort of COVID online world. A key result of this for Asia, if we look at the chart on the right, is that Asian exports to the EU and the US are already back above pre-crisis levels. And this has given the region quite a lot of support, more than would normally come at this stage of past recessions in the West. I said earlier that a lot of this has to do with fiscal stimulus, and I'm sure that the United States just passed yet another new massive fiscal stimulus program. What we're showing you in this set of slides is the US has really taken the lead here with huge stimulus, the CARES Act in the second quarter of last year, a top up to that in December of last year, and then a week ago, the US passed a roughly $1.85 trillion package that equates to about 8.5% of GDP. Not all of that will hit the economy this year. The majority will. There'll be some that will spill over into 2022 and 2023. And in the case of the US, there's more to come. So it seems highly likely that President Biden will be able to push through a large infrastructure spending plan, his Build Back Better plan, by, roughly speaking, September of this year. Most estimates there, and there's a lot of uncertainty. I want to stress that there's a tremendous amount of uncertainty. But estimates there would be that that plan could be as large as $2 to $3 trillion. So let's call it the lower end of that, around $2 trillion, around 9% of GDP, spread over essentially 10 years. So an additional roughly 1% of current US GDP per annum spread over the next 10 years. So that'll give some support to economies as well. Europe hasn't done quite as much, and I think that's one of the key differentiations between the United States and Europe and the extent to which they have recovered. Europe's recovering a little bit more slowly, in part because fiscal policy there was aimed at supporting economies rather than really stimulating economies. Now, if we look at the other key aspect of how policy has responded in this crisis, it's that monetary policy moved much more aggressively and to a larger extent in this crisis, literally in the first several months, than it's ever done before. Certainly, the Fed did more work in terms of the number of programs and the injections of liquidity into the system and the size of programs in the span of essentially a month and a half than it did in 5 years of the global financial crisis. The key point that I would make is looking forward, what the chart is showing you is that these aggressive monetary expansions are going to continue through the end of this year. We've seen that from the ECB statements about buying bonds. The Fed has made clear that it's going to look through what's a likely bounce in inflation and sees no reason to change any of its monetary policy settings, either the Fed funds rate or its QE program, anytime soon. And that really pushes into 2022, and probably looking at the dot plot that we just got from the Fed that gives us individual Federal Reserve member projections, that they probably won't raise rates until sometime in 2023. As a result of this, we expect global GDP to recover this year to about 5.2%. I'd add, I think we're a little conservative in that. You know, we're not trying to be particularly or overly optimistic in that estimate. I've seen a lot of estimates from other forecasters that are higher, but 5.2% for global GDP growth is going to be a lot of recovery. And as we go into 2022, we would expect global growth to slow a bit, but still remain fairly robust. This is going to be led by the US economy. And that's an amazing statement. You know, we've come to be used to China leading global growth, but in this case, because of that massive fiscal stimulus in the United States, it's really going to be the US economy that's going to be pulling the world forward. The chart on the left shows you that in the third quarter and the fourth quarter of this year, we estimate US GDP growth will be about 7.1%. We think in the third quarter of the year, sorry, I apologize, second and fourth quarter. In the third quarter of the year, we estimate the US growth will be close to 8.5%. Now, I had to look back. In my career, I started in this industry in 1991. I've never seen the US economy grow that rapidly on a sustained basis. That is, you know, sort of 7, 8, 7. You really have to go back to about 1983 to see those types of growth rates on something of a sustained basis. What's more astonishing is if we look at the chart on the right, what I'm showing you here is that because of this rapid sustained growth, the US economy is going to return to trend GDP levels by essentially the first quarter of next year, if not maybe even a bit earlier, and then go above trend into 2022. So this is just an astonishing recovery driven by very easy monetary policy and very expansionary fiscal policy in the United States. In contrast, China was first in to this crisis. COVID originated in China. China installed lockdowns, you know, much earlier than anyone else. It saw the big hit in its economy as a result before any other economies, and it has been first out. It was the first economy to really recover, and it posted 2.3% GDP growth last year, one of the only economies in the world to grow. As a result, policy in China is ahead of the rest of the world, and policy is beginning to sort of lean against the recovery. It's not trying to kill it. It's trying to just make sure that it doesn't allow it to become too robust, doesn't allow overheating. So there's some degree of moderation that we're beginning to see in the Chinese economic cycle. We expect China to grow about 7.1% this year. But with growth really kind of peaking in the first quarter of the year and then moderating through the year. Nonetheless, when we look at that tremendous stimulus from the United States, still pretty robust growth from China, and a recovery in Europe that we would expect in the second half of the year, that's a lot of support for the global cyclical recovery. And Asia is the region in the world that is best geared to that. What I'm showing you here is that leading indicators for Asia particularly Asia's export sector, and I'm showing you here industrial metals prices, but I could just as easily use something such as the US ISM New Orders Index or the global PMI New Orders Index, points to a real surge in Asian exports over the next quarter to 2 quarters. This could be a bit choppy in that we know that there have been some factors that have disrupted supply chains globally. So some problems in the semiconductor sector and the recent freeze in Texas that's hit both semiconductors and plastics. But on trend, this massive pickup in demand globally, led by the United States, should be over the next quarter to 2 quarters very positive for Asian export growth. Now, an implication of that is on the next slide, which is that historically corporate profitability in Asia, and I'm showing you listed corporates, tend to follow the export cycle very closely. So if we do indeed get a substantial pickup in export growth, it's likely that corporate profit growth across Asia is going to pick up substantially as well. Now, into the second half of the year, and certainly into 2022, we would expect tourism to add to that recovery. It's going to be led by industrials and exports of goods, but then as the world gets vaccinated and Asia gets vaccinated, we would think that services, especially tourism and travel services, would begin to recover. I'm not saying that this is going to happen soon, but rather, late this year, early next year, and that'll add a boost and a bit of sustainability to growth in the region into 2022. A global concern, certainly for the United States, is that all of this stimulus could be inflationary. We expect inflation to rise. We see a good chance that US inflation on a year-on-year basis will rise to above 2.5% over the next several months. There have been some supply shocks. There have been some one-off price increases related to COVID. And crucially, there's a base effect. But on a trend run rate basis, so, CPIs, core PC, month on month, month after month, annualized, we expect inflation in the United States to go up to about 2.3% by the end of the year, but we don't see it becoming problematic. Why not? Well, we would note that in 2019, the end of 2019, the US had experienced its longest expansion in history, and the unemployment rate was a low of 3.6%. That was something that I'd never thought that I would see in my lifetime. And yet we still, despite that very long expansion, despite a very low unemployment rate, we still didn't have meaningful inflation. We expect there to be a bit of a pickup in inflation with this cycle, but we just don't see structural drivers of a return to the type of inflation that people worry about, which is, something similar to the 1970s or the very early 1980s. And on the point of stimulus, I think that one of the key things to remember is that high inflation period in the 70s and the early 80s, it didn't come along because of 1 or 2 years of fiscal stimulus. It took literally a decade of very easy, very expansionary fiscal policy in the United States, funding the Vietnam War and Lyndon Johnson's Great Society, combined with very easy monetary policy to create that inflationary impulse. In this case, we've got 1.5 years of massive stimulus, and then it tails off pretty quickly. We've got a couple of years of very easy monetary policy, but a Fed that is telling us that as they see signs of inflation emerging and meeting their targets, that they will begin to change policy. And I think I should take them at their word for that. Now, what about the rest of Asia? Inflation starts at very low levels. It was quite low before the crisis, and we expect it to remain pretty modest. The only exception is India, where there is something of an inflation problem. A consequence of this is that through most of Asia, inflation probably doesn't rise much, and there's no need for policy tightening, again, other than perhaps in India. The best way to think about that is that what I'm projecting here is output gaps for the region, the shortage of output relative to the potential for economies to grow, despite pretty strong recoveries in growth in 2021 and 2022. What the chart's showing you is that most countries are going to still be running large output gaps even in 2022, and that's going to lean against inflationary pressure, preventing central banks from a need to raise interest rates or tighten policy. China is the key exception because China did better than other countries last year. It actually grew, and China is more concerned about some areas that it deems to be potentially sources of bubbles. In its equity market, there's some degree of concern. It doesn't want to try to repeat 2015, and it remains concerned about property. So China has already entered a period of policy moderation. That's largest, we think, in fiscal policy, where the budget deficit is likely to shrink this year relative to last year. But we also see some signs of that in monetary and credit policy as well. So credit growth, money growth is expected to slow this year, and that'll help to keep a lid on Chinese inflation. Let me end this with just a word about currencies. I'd say a few things. The first is, I think it's important to remember that when you're thinking about Asian currencies versus the dollar, your starting point really needs to be the dollar versus the G10 currencies. And that's because the long history of emerging market currency performance suggests very powerfully that emerging market currencies follow the direction that the dollar takes versus the major currencies. The dollar's recently rallied a little bit against the euro and the yen. A lot of that has to do with Europe's troubles in trying to roll out its vaccination program. But we tend to think that as Europe gets its act together, as Europe gets vaccinated and growth begins to recover in the second half of the year, that the euro will recover back to about 120 and ultimately about 122, and that the yen will also recover, with dollar yen falling to about 106 by the end of the year, or on a 12-month basis. In that world, that should help to support Asian currencies, but crucially, Asia's fundamentals should also support its currencies. What I'm showing you here is current account balances across the region. Most countries are running large surpluses, and surpluses that are larger now than they were a year ago, 2 years ago. As a result, there's a lot of fundamental support for these currencies. We'll still move directionally with the dollar, but there's really very little risk of any significant Asian currency weakness as US interest rates rise. I'll stop there and turn it over to the next speaker, I suppose.
Yes, thank you very much, Ray. We now move on to our second speaker, Mr. Federico Rafael Ocampo. Fritz.
Thank you, Ned. Good afternoon to everyone. I'll just load my slides. Can you see my slides already?
Yes, we can.
Okay. Good afternoon to everyone. So, as Ray mentioned, the world is gearing up for a recovery, and the pace of recovery will differ from one economy to another. What I'd like to discuss would be bringing the topic down to the local setting. In particular, what will drive Philippine economic recovery? Will interest rates remain low, as we saw last year, and can Philippine stock market resume an upward trend? And is the peso strength sustainable? So at around the midpoint of last year, I think I guessed it in your conference as well, and I talked about the Philippines heading for its deepest recession in 35 years, and I showed the slide on the left. And I was talking about the 84, 85 stagflation years. Boy, was I wrong. Um, it became our deepest recession since the end of the Second World War, as we contracted by 9.5%. The positive slant here is we have seen the worst in terms of the real economy, and we're now looking at a 6% GDP growth in 2021. Consumption, which led the growth the last 20 years on the right side, was badly hit, and COVID-19 could impact our long-term growth drivers. And so if you look at this slide, clearly the lesson here is we have to contain the spread of COVID-19, and vaccine rollout will be very important. This is our latest forecast. It's quite busy, so allow me to guide you through them. On the first line, if you want a headline, we're still looking at a contraction of 4.3% in the first quarter of 2021. The recovery will begin in the second quarter, which was the worst point of last year, wherein we contracted by 17%. So we're looking at a bounce of about 14.5%. And hopefully, as the vaccines arrive in the Philippines in the second half of the year, then we'll have a more stable 7.2% growth in the second half of this year. Will we be able to recover fully our pre-COVID levels in terms of GDP? The answer is no. Full recovery will come in 2022. But hopefully, we will be able to recover 96% of what we lost, or 96% of 2019 levels. I guess this is the first point we're making here. The second point is your growth driver, which was domestic consumption or household consumption, will continue to be hit in the first quarter. But moving forward, we'll see a bounce back, especially on non-essentials, which was badly hit, and it contracted by 30% in fiscal year 2020. As many of you, many of us, we're just consuming or purchasing essentials, basically food and beverage, as well as anti-COVID devices, no? From alcohol, masks, face shields, and the like. The third point we're making here is fixed capital formation, which is investments led by you guys, no? The private sector, which complemented domestic consumption since 2013 onwards, was also badly hit, and we'll show some breakdown slides later on. Hopefully, this will also recover as the business sector regains its confidence as the vaccine starts arriving in the second half of this year. Meanwhile, we're seeing some good signs, and I'll show you a slide later on. Last point we're making here is public construction will be a growth driver this year after it was reinstated in the 2021 budget, accounting for 1/5 of the budget. And infrastructure spending definitely has the highest multiplier effect. So Omar was asking me, Fritz, how are we doing after the vaccines started arriving in the Philippines? And this is our latest indicator of what the Filipinos are doing. This is from Google data, and this is specifically for the Philippines. So it shows what Filipinos, or how Filipinos are doing going to retail and recreation, grocery and pharmacy, transit station, and workplaces. And clearly on the left slide, after the ECQ was declared on March 15, you had a plunge of close to 80% from pre-COVID levels. And as we move to the right of the slide, as we reopen the economy and move towards GCQ in June, your indicators definitely improved. As we started preparing for the Yuletide season in November and December, the dark blue, which is Filipinos going to the grocery stores, already exceeded pre-COVID levels. And then as the number of COVID cases started rising anew, post-Yuletide season, you see the numbers softening once again. And what we encircled on the rightmost with the recent surge and the appeals to stay home once again, no? Expect these numbers to pull back in March and April. So as Ray mentioned, we are headed towards the biggest vaccination campaign in our history, definitely that we've seen in our lifetime, our generation. On the left part of the chart, not surprisingly, the developed markets, those with financial resources, were able to access the vaccine ahead of the emerging markets. And the reason for this is they started signing contracts, number one, and started placing down payments as early as May and June of 2020. And therefore, as the vaccines were approved, they were the first to access the supply. That's the first challenge because of the demand, the hot demand for vaccines. The supply has to be ramped up, and the more choices we have globally, the better it is. And from 2 vaccines, it has now increased, as Ray showed us earlier, to more than 6 vaccines globally being distributed. The second challenge is vaccine administration. And at the center of the slide, you'll see that Israel and United Arab Emirates are the most efficient in terms of vaccinating their population. And this includes everything from scheduling to physically rolling out the vaccine, to setting up centers, to defining who will put the jabs in terms of doctors and nurses and the like. And on the right side, we'll see how ASEAN is doing. And unfortunately, the Philippines is lagging behind, rolling out an average of 21 doses per day compared to Indonesia, which is now doing 250,000 and has already rolled out 1 million vaccines. I think if we stare at slide 7 and wonder, when will I get the vaccine? When will my family get the vaccine? Then we'll see that still a lot has to be done. And for our personal interest, our family interest, it is very essential that we get the vaccine at the soonest possible time. On slide number 8, we show you what the Philippines has actually ordered. On the left slide, current orders in millions. So the people in government have identified that we need to bring in 70 million for 70 million Filipinos in order to gain herd immunity. If you look at the left chart, it's actually a diversified pie chart wherein we're trying to source from different suppliers, with the government allocating its government resources mainly in favor of Sinovac and Sputnik 5 or Gamaleya, while the private sector, led by the conglomerates as well as the different business groups, have ordered from AstraZeneca and Moderna. The first 1 million vaccines that have arrived so far are all donated. No, we didn't purchase them. So disabuse your minds that we actually purchased anything yet. On the right side of the slide, you'll see that really the Filipinos need to push, both the government and private sector to to bring the vaccines to our country. Many are asking me, what does recession mean? So both Ray and I showed us that in 2020 we experienced a global recession. What does a global recession really mean, or a Philippine recession? So recession means negative GDP growth or a contraction of your economic pie, and the real impact here is in terms of the jobs lost. So on the left chart, we started pre-COVID, January of 2020, at an unemployment rate of 5.3%, really very close to our full employment rate. Same with the US, as Ray showed earlier. The world and the Philippine economy was really, accelerating at a pace that we've never seen before. We were creating jobs, in part because the private sector, you guys, were just expanding your capex or investments to expand your business. And then COVID hit, and in April, our unemployment rate hit 17.4% headline inflation. But if you look at the middle, the April numbers, that was 7.2 million that was unemployed, but you had 4 million entering the labor force. So together it brings it to 11.3 million, no, that were unemployed. The 4 million were really the fresh grads, coupled with people turning 15. And in our labor census, 15 is part of your labor force. So this shows that a young population like the Philippines also produces a lot of supply or new supply into the labor market. And then as we reopen the economy, the unemployment rate starts to go down, and by January of this year, it was at 8.7 million, but that was still close to 4 million in terms of people who are out of jobs. The underemployment rate equally rose to 16%, meaning people couldn't survive with one income or one source of income. On the right side of the chart, we show you that while a lot of people lost their jobs in NCR, people went back to the provinces. And look at the charts in terms of Luzon x NCR. You created 3.6, new jobs, and in Mindanao, 2,650 new jobs. Meaning, as people went back to the provinces, they continued to look for work. What kind of work did they find? I surmise to say that some of them got jobs in the BPO sector, because the data shows that the BPO sector remained resilient throughout the year in 2020. Agriculture, however, lost jobs as we were hit with a series of typhoons. Typically in the second half of this of any fiscal year or any calendar year. On slide number 10, we try to show you where are Filipinos employed in terms of the sectors, and clearly it's the services sector that employs the majority of Filipinos today, highlighted in the dark blue part of the columns. And this is in tandem or reflects that the Philippine economy today is a services-driven economy, no longer an agriculture-driven economy in terms of job creation, as we were taught when most of us were still in school. And the reason for that is when you look at it, services accounts for trade, retail trade, wholesale trade. It looks at the telco sector, the banking industry, the BPO sector, and the tourism sector, which according to Secretary Berna Romulo Puyat, now accounts for 5.7 million Filipinos, or is close to 10% of GDP. What is also the impact of COVID-19 and the recession would be, as people lost their jobs, as both the government and the private sector cut the payroll, people now move towards being self-employed or owning their own businesses. And this is what we see in our apps, a lot of Filipinos selling food, selling anti-COVID devices, selling alcohol, masks, and face shield. If I were to spin this, and Romy can correct me later on this, if I were to spin this, this could be both a positive and a negative. On the positive side, I'd say that this 12% could now be our new entrepreneurs. On the other hand, you'd say that this is a reflection of the poor labor market. Yes, it's true. But once you guys start expanding CAPEX again and start hiring again, this self-employed or entrepreneurs could also shift back and become the additional supply in our labor market, as big and medium business begins to hire workers once again. This slide shows us the impact of shutting down our economy. And clearly, as I mentioned earlier, the consumer sector or household spending is a driver of growth. But as we shut down the economy, you'll see here that people were just focusing on purchasing essentials. So the beneficiary would be Pure Gold, SNR, RHI, Robinson's Retail of Robina, and purchases of non-essentials were hit badly, as reflected by Wilcon. How could you continue with your house renovation or construction of your new home when the economy was shut down and the job sites were locked down as well? And here we show both in terms of same-store sales growth as well as net income, and clearly the non-essentials were hit badly. The opposite is also true as we reopen the economy and we ease up on mobility restrictions. Then the non-essentials bounces back also immediately. Slide number 12 is my positive take on 2021, and on the left chart we see how CAPEX declined by close to 30% in 2020. Entering the year, the CAPEX expansion was supposed to continue on its 8th year, but because of the lockdown and mobility restrictions, stay-at-home orders, all of you guys started to cut CAPEX, with some large corporates cutting by 40 to 50%. But the good news here is, as the 2020 earnings season is about to end, we're seeing now a rejuvenation of CAPEX, with an expected 22% growth in CAPEX expansion for the year 2021, with a total of 1.1 trillion pesos expected to expand Philippine business. On the right side is the pie chart, the distribution. Clearly, it will be led by the conglomerates. But look, property is back there at 21%, and telco, because of the increased demand for broadband, and the entry of a third challenger, or a third player, is a very significant part of the pie chart. So I've talked about consumer demand. We just finished investments, you guys, fixed capital formation. The third driver of growth is government spending, and more than ever, the government has to step in right now, because confidence, both consumer and business confidence, remains very shaky. So on the left chart, we show you what the bulk of the national government has been through the last 3 years, which are social services, economic services, no, and general public services. On the right chart, we'll show you that capital outlays, no, is 20%. This is your build. This is your infrastructure spending, and the bulk still goes to maintenance and other operating expense. The budget is one thing, and we have a 4.5 trillion national budget in 2021. Deploying it and spending it in a timely manner is another thing. And what we just want to highlight here is releasing the budget and spending it early, especially for the infrastructure spending, is very crucial in order to realize the economic recovery that we're all dreaming at for 2021. For instance, in the first and second quarter, you'll see that the actual spending was actually strong in 2Q of 2020, but the actual spending really went to COVID relief already. No? For infrastructure spending it in the first half is very crucial. Why? Because we're hit with poor weather or typhoons, an average of 22 every year in the second half of the year. The main concern of financial markets today is inflation, as also highlighted by Ray's presentation earlier. In the Philippine context, the pie chart on the left would show you that 80% of the consumer price index is still weighted in favor of basics. No? Food and beverage is 38.3%. Housing and utilities, that's 22%. Eating out in restaurants and miscellaneous goods and services is less than 13%. This actually collapsed in 2020. And so a recovery will see some cost push pressure in terms of this item. And then, of course, transport. As you shut down the transport sector, it becomes more expensive to move around the metropolis. As you open public transport, then that eases up on your cost push pressure. During the last 4 months, we've seen cost push pressure from food. Why? Because of our typhoons in the fourth quarter of last year, the African swine flu, and definitely the shift from eating pork to eating chicken. So on the right chart, we show you that the good news is some vegetable items have started to pull back, in particular tomato and onions. No? The second good news, rice, which is in gray, is now relatively stable. No? But your chicken, the black line, is still moving up. And for you, those of you who go to the public market or even supermarket, you'll see that the size of our chicken is very small. So they're already being harvested in order to take advantage of the high prices in the marketplace. Moving forward, will this continue? The importation that has been allowed by the government is expected to increase the supply of food items and definitely result in a pullback in retail prices. Our study shows that we are close to the peak. On the right chart, if you look at it in terms of quarterly, we believe that the first half of this year will see the average inflation at 4.5 to 4.6%, but it will slowly ease in the second half of this year. So aside from food, the other pressure point has been the price of Dubai crude. As we'll see on the left chart, inflation and Dubai crude or oil prices really has a very strong or high correlation. When oil pulls back, as it did to $20 per barrel last year, your inflation becomes benign. When Dubai crude moves up to $60 and higher, then so does your headline inflation. And for an oil importing country, this is an important data to track moving forward. So full year, we're forecasting 3.8. Last year, we forecasted 2.5. So we were just 1 basis point away from the actual number of 2.6. This year, the BSP is projecting 4 against our 3.8. And if the direction is correct, that inflation will ease up in the second half of this year, then that will be good news for the BSP. That will give them ample room once again to cut interest rates. On slide number 17, we show you that peso interest rates, in particular, the 10-year fixed rate treasury note, moves in tandem with the headline inflation. This is very clear on the left chart. So what happened in 2018? This part of the chart. Remember, in 2018, government decided not to import rice. And therefore, you saw headline inflation soaring. The impact was your 10-year hit a peak of 8%. No? And that's why on the right chart, in terms of forecasting interest rates, we showed you that we believe that interest rates will not move close to the 2018 levels, which is the orange bar. And in fact, we believe that because of our view that inflation is about to peak, the yield curve has already steepened with the inflection point at the 7-year, and the recent auction at 4.48 for the 10 years, or close to 4.5. No, you compare this with the 2.9 levels that we saw last year, our historical lows, and therefore, if we are right that inflation will begin to pull back in the second half of this year, then your long end of the curve will also shift downward. No? And therefore, if interest rates remain at these levels, for those of you guys who have retired, then it becomes challenging how to invest and reinvest your retirement benefits. No? Because living on interest could become very challenging because we are faced right now with negative real interest rates. In terms of the stock market, so the low, or the worst point, was on March 19, our first few days of the ECQ, or the lockdown, when the market plunged by 41% to 4,623. We had a rally in the second half as the government announced both fiscal and monetary stimulus, or the central bank started cutting interest rates, both policy and reserve requirement, while there was a lot of speculation about fiscal spending or increased government spending. So we closed at 7,140. We're currently consolidating at the 6,566 level. We remain the laggard stock market in the world and in ASEAN. We're still down 10% year to date. Many have already recovered. Why is that happening? On the right chart, we show you that foreign net outflows continues. No? In 2020, we had our single largest year of foreign fund net outflows at $2.5 billion. Year to date, we're already at $865 million. This makes this the fourth consecutive in a row wherein we're seeing foreign fund managers continue to leave the Philippine stock market. So who remains in the Philippine stock market? It's just driven by local retail. No? For the first time last year, a local broker called Financial ended up #1. And then in January of this year, you'll see that 7 of the 10 top brokers are all local. No? What are the local retail investors buying? Aside from your usual suspects of SM and Ayala Group and Metrobank, a lot of speculative plays. So is the Philippine stock market expensive or is it cheap? In terms of PE ratio, we've now pulled back and we're moving closer to the mean of 16.7 times PE. At 7,100, we were trading at 19 times PE, very expensive for the Philippine market. What is cheap right now would be the banks and the property counters, still trading at below price to book of 2.2 times, currently at around 1.3 to 1.5 times price to book. BDO forecasts 7,600 by year end. This assumes a 40% EPS growth compared to the 42% contraction we saw in 2020. And at this level, it would be trading at closer to 19.5 times PE. Finally, let's talk about the peso. The peso appreciated by 5.5% last year. We believe it was really on account of the collapse of our imports. On the left chart, we show you that capital equipment, raw materials, and intermediary goods account for 70% of our total imports. In terms of our top commodity imports, it's really fuel, oil, lubricants, related materials. And you see that it shrank by half, on the right top chart. That shows you that in terms of the trade balance, we remained in deficit, but the deficit also shrank, from 40.7 billion trade deficit to less than 22 billion US dollars. And therefore, theoretically, a total of $20 billion was not purchased by both the government and the private sector to pay for the import bill. So what happened to that money? It remained parked in CASA in pesos. And that's why all the banks reported higher CASA levels in the year 2020. So on the left chart, after appreciating, we believe that as we reopen the economy, especially in the second half as the vaccines come in, then we will import once again. And slowly your peso will begin to gradually depreciate once again towards the 49, 60 level by year end. So in summary, slide 23 summarizes what I've been talking about. And clearly from the deep recession of 2020 to a recovery story of 6% growth is positive. You'll see some upward pressure in inflation and interest rates, but we believe in terms of your medium to long-term view, you're still staring at historically low levels. The US Fed will not raise interest rates this year, although the secondary market is beginning to price it in. And in terms of the stock market, as I mentioned, it doesn't seem like it right now, but we believe that a second half recovery remains on the table. So in summary, what will drive Philippine economic recovery? It's easing mobility restrictions, successful rollout of the vaccine, and an aggressive government spending led by infrastructure. Will interest rates remain low? Historically, yes, this will still be historically low levels, although it's now up by 100 basis points, driven by cost-push inflationary pressures. Can the PSE resume its uptrend? Yes, most likely in the second half, but we need to see more catalysts in order to boost investor confidence. And finally, is the peso strength sustainable? We believe that the peso strength was temporary, and that as we reopen the economy, our imports will lead to a higher demand for the US dollar once again. With that, thank you very much, and we open ourselves to questions.
Thank you very much, Fritz. Before we go to the Q&A, though, we have invited two distinguished panelists with us this afternoon. We have invited our first reactor would be the Chief Finance Officer and Chief Compliance Officer of SM Prime Holdings Incorporated, Mr. John Nai Peng Hong. His key responsibilities include overseeing the financial and risk management operations of the entire finance unit for the malls, commercial hotels, residences, leisure, and the head office of SM Prime. He also heads the IT group of SM Prime. He is a director of SM Prime subsidiaries and a member of the SM Prime Executive Committee. He was previously an SGV partner where he worked for 13 years. He's a certified public accountant and holds a master in business management from the Asian Institute of Management. He has a Bachelor of Science in Accountancy from the Ateneo de Zamboanga University. Our second reactor is Romeo Bernardo, who has had a varied career in public institutions before he co-founded LBT with former Energy Secretary Del Lazaro and corporate lawyer Helen Chu in 1997. His public sector work spans teaching, financial management at the University of the Philippines, a career in the Department of Finance, rising to the undersecretary post, and working in multilateral institutions such as the IMF and the World Bank in Washington, D.C., as well as the ADB in Manila. Presently, he provides business advice and sits as a director in leading Philippine companies such as the ALFM family of funds, Bank of the Philippine Islands, Globe Telecom, Aboitiz Power, RFM Corporation, Philippine Investment Management or FINMA. He also continues to provide policy advisory for multilateral and bilateral institutions and the Philippine government in public finance, capital markets, public-private partnership, pension reform, economic governance. He's the lead Philippine partner in Global Source Partners, a global network of independent analysts. He's also a member of the Philippine World Bank Advisory Group, Philippine Statistics Authority Board of Directors, Management Association of the Philippines Board, Phoenix Foundation Board, and the International Center for Settlement of Investments Disputes Panel of Conciliators. Mr. Bernardo received a Bachelor of Science degree in Business Economics from the University of the Philippines, magna cum laude, and a master's degree in Development Economics from the Williams College in Massachusetts, USA. Ladies and gentlemen, may I present our first reactor, John. John?
Yes, Ned, good afternoon, and thank you for the kind introduction. Well, good afternoon. And well, please allow me to put on my mask at this point in time, right? Well, I'll go through I've gone through the presentation of Mr. Fritz Ocampo as well as Mr. Ray Faris, and most of my comments and reaction would be more on the local level, which is on the presentation of Mr. Fritz Ocampo. Okay, at this point in time, I totally agree with the points, the key points raised by Mr. Fritz Ocampo, and I would like to go through some of them. Right, first, consumption, which is 73% of GDP, has been the key driver of growth. Second, easing of the mobility restrictions as well as strong spending and consumption are essential to our economic recovery. Third, large companies combine to provide necessary support as reflected by the CAPEX plans for year 2021. The timely spending of the government as well as the private companies as presented by Mr. Fritz are key to the economy. Now, what I will do is I will react by sharing with you certain levels of details that reflects the support of our industry and SM Prime in particular. Now, in terms of our proactive pandemic efforts, I would say that the pandemic has brought the public and private sector to work together, right, to help the country in particular. We partnered, SM Prime in particular, we partnered with the government to provide PCR swab testing in our Mall of Asia, which we turned into a mega swabbing facility. The vaccine and the vaccination program is a critical assumption that we had for us to recover. So in our year 2021 budget, we factored in, and a significant assumption is the vaccination program that will take effect this year 2021. We partnered with the government for this effort, as well as with private companies and agencies to procure the vaccines, to the effect that half of what we ordered will go to the public, to the government for public use. No? The vaccination program, in particular in SM Prime, is voluntary and free for our employees. No? We will start the rollout. And that would be as soon as the vaccine are made available to us. The vaccination activities of the government is moving, and we believe that the economy is on recovery once we reach the ideal 70% level of the herd immunity. Now, what I will share is perhaps certain more details of what we did, of what we are doing, and of what we are looking forward to. It would be specific SM Prime, but as you listen through it, it is rather industry, the real estate industry in particular, in general as well. What we have done as of today is that we at SM Prime, we remain to be operational despite of these changing quarantine measures in different parts of the country. As we are all aware, we are on a stricter GCQ now in Metro Manila, as well as certain specific parts of Luzon, while we are already in MGCQ in other areas. No? What we have experienced is that we were able to generate better foot traffic, as well as improve tenant sales in MGCQ areas as compared to the more restricted GCQ locations or mall locations. Now, in support of our economy, the SM Prime has provided rental concessions to tenants, as well as support to various stakeholders. And by various stakeholders, I pertain to our contractors, suppliers, our employees, as well as the service sector. That means the intent is really for us to continue with our business operations, to maintain employment for everyone to the extent possible, and that support will maintain the existence also of our tenants in the malls. Support has also been extended to our contractors who are developing our malls, as well as our residential projects, to the extent that we are working together to the effect that they can come back and as at this point in time, contractors had already mobilized up to 75% of their capacity in our residential developments. SM Prime continues to innovate in its business, primarily the malls, residences, as well as our hotels and conventions, as well as providing the security and safety protocols in all our properties. That is to help the government in terms of preventing or reducing the spread of this COVID virus. We acknowledge the changing behavior in our malls. In particular, we had accelerated our e-commerce platform to help our consumers as well as our tenants by providing personal shoppers as well the click and collect services, as well as online deliveries. We had accelerated the introduction of our SM Malls online application, so which means that you can download these applications on your Apple and Android devices anytime now. What we are currently doing is that location really matters. No? That's why we are ramping up services across our areas, providing new solutions to our tenants in such areas, especially those under stricter safety measures. While we are still in this pandemic condition, to continue supporting our government as well as economy, we opened 2 new malls in year 2021, in year 2020, and those 2 new malls are located in the provinces, in Mindanao in particular. For the current year, we continue to develop, and we are looking forward in opening around 3 new malls while continuously expanding existing malls. While we continue to maintain prudence in terms of our capex plans. What we are looking forward is that we will continue to work closely with the government in terms of the COVID, the program, in terms of vaccination program. We will continue to work closely with our tenants, our contractors, the government employees, as well as our suppliers, in support of, again, looking forward to the essential recovery of our economy. We continue to see the changing environment brought about by this pandemic condition and the changing consumer behavior. That's why we have to make adjustments in terms of our configurations in the malls, the design and development of our residential projects, as well as our office and commercial projects. Design will be reconfigured by working to convert more open spaces. Even with the existing ones, we are trying to see how we can open up more spaces. It's more of converting some of our amusement and leisure areas also towards multi-purpose halls that will cater to requirements of our tenants as well as the consumers. So which means that certain areas in cinemas as well as the amusement has been reconfigured, and we are converting them, and we had actually converted them into multi-purpose halls as well as open spaces. All these are being performed with a view of one, working towards supporting our economy. Hopefully, with the vaccination program and availability of the vaccines, we would be able to get back and achieve the percentage of economic recovery as indicated by Mr. Fritz Ocampo earlier, and that you would be assured that companies like us in the real estate industry, we will continue to provide the necessary support in terms of our capex plans for year 2021 and moving forward. With that, I again would like to thank Mr. Ned for hosting this, and also Attorney Francis for the kind words as well before this program. Thank you.
Our thanks go to you, John. Our second reactor is Mr. Romy Bernardo. Romy, can I
Hi.
turn
Hi.
over to you?
Yes. Thank you, Ned. I was just going to congratulate and thank the two speakers for their excellent and comprehensive presentation and leave it at that. But because of your very fulsome introduction of me, I'll have to maybe respond to the request of Fritz to elaborate on some of the points that he covered.
Thank you, Romy.
Let me. I do have some slides, but I think I'll do more ad-libbing and try to respond to some of the points. Just to sum up, start with my conclusion. My take is very much aligned with what the two previous speakers had said, that what Mr. John Hong had said, and in particular to the four questions that Fritz raised. I agree completely with him on all of his answers, but his answer is contingent on one very important thing: the direction of the virus and how quickly our health officials can manage it. And this is maybe I'll go to my slide just to show how important this is, and I'll elaborate on what that means if our health officials are not able to manage well enough. Please, kindly. Okay. We're all experiencing this now, especially those among us who are over 65. This is the surge in the incidence rate, And in contrast to what was presented by Mr. Faris, shown in the table on the right, ours is surging, whereas everybody else in our region are coming down. The thing is, I don't think this is going to be a one-shot thing. I think the course of the virus with its mutations and the big questions on the vaccination, which I'll come to, means that there's not the movement towards a opening of the economy and revival is not going to be a smooth one, but rather it will be stop and go. Now that has several implications on investment, on government's investment program, on behavior of people, and so on. Let me go to another slide. Next, please. Well, yeah, this came from an Economist article several months ago. This is still the case for the Philippines, although, as pointed out by Mr. Faris, the developed world has pretty much showed that it can be done and it can be done well. But unfortunately, we're not there. Not only is the vaccination rollout challenge, but even some of the things that we've been trying to come to grips with, like contact tracing, is still not being managed, and in some ways may have contributed to the recent spikes. I know that Mr. Secretary Galvez has been appointed to look after vaccination. He's a good man and he's trying very hard, and he has signed up, or rather have begun to get commitments for vaccine deliveries by the second half of this year, which should be enough to vaccinate enough Filipinos to attain herd immunity. He also talked about a achievement of herd immunity by 2021. Now, that is a very bold aspiration, and some of us have done back of the envelope calculations that would require a rate of vaccination of about 500,000 a day. As our president pointed out, of the vaccines that we've had, and we've already had a couple of weeks, we've not done even 500,000 for the health workers. So that is an aspiration. My own assessment, talking to experts, is closer to what Mr. Faris said about the developing countries. It will probably be around end of 2022, which means that we have one whole year this year and all of 2022 to try to dance with the virus. And that means dancing has a lot of implications. Quite apart from the mobility issue, there is the issue of scarring. People have lost their jobs. And while I appreciate much the presentation of Fritz Ocampo on unemployment, but I think we'll have to dig deep on those numbers. What we're not seeing is the two things. Number one, the loss of quality jobs. When people go to the province, I hope Fritz is right that they go to BPO, but many of them simply go to their subsistence farming, because if you don't do anything, you don't eat. So they go to subsistence fishing. In the urban areas, they sell cigarettes and that sort of thing. Again, this is not the kind of employment that generates healthy GDP growth. Number two, we also seeing some job sharing. The Department of Labor rightly has allowed jobs to be shared. Instead of firing 5 people, what they will do is to allow 5 people to share a job. They will all be counted as employed, but we all know that they only have 1/5 of a job. So again, the hollowing out of employment will continue, and this will continue not just during the period that at its worst last year, but may continue if we're not able to come to grips with the spikes in the virus. Number three, people's savings have been exhausted. Maybe they've been able to cope with it, but we all know that only 20 to 30% of the people have banking accounts and very low levels. Most of people don't. They've exhausted it, and government has indicated that it's not prepared to provide more ayuda, what they call it, which is income support. And I can go to that in the fiscal side later. For all those reasons, as well as the possibly continuing problem in undertaking investment by the government because of the mobility restrictions as well. I think we will, the recovery will be quite delayed. Can we go to the next slide, please? Okay, this is what I'm talking about, the stringent lockdowns. Next, please. Next, please. Sorry. Again, next, please. Okay, let's talk about fiscal response. The left slide shows Philippine fiscal response versus our neighbors. It's been quite conservative, and I think the Secretary of Finance has been quite clear on his reasons for wanting to be conservative. I think number one, he's already seeing an increase in the deficit to GDP because of the hollowing out of the revenue base and the split spending. It is now something in the order of 7 to 7.6 last year, and I think it's expected at 8.9 this year. This is about triple what it was historically, and this will bring up our debt to GDP from about 40% to close to 60% this year. The reason the secretary gave, and we're seeing it now, is we don't know how long this pandemic will last, and I think we've just been shown that there are question marks on how quickly we can get out of this. Second is there are pressures on the fiscal side beyond the pandemic that we have to be worried about. Number one, the passage of the Mandanas ruling of the Supreme Court that basically carves out from the national government's revenue the equivalent of 1% of GDP to give it to the local government. Number two, the ballooning pensions of the military that grows at a rate of 3 to 4% every year because of the formula that's been put in place. And finally, number three, contingent liabilities, which should only grow because of the pandemic. When I say contingent liabilities, I mean the obligations of PhilHealth. I mean potentially problems of banks that will need to be funded by fiscal side. I mean additional exposures to help out strategic industries. So all this will exert pressure on the fiscal side, which means that the national government will have to continue to be conservative in its spending. Although I do take the point of Fritz, that perhaps in response to this latest surge, and as we come closer to elections, there will be more pressure to provide more support, income support to the poorest, to the most vulnerable. And I would not be surprised if there is additional fiscal spending that happens towards the end of the year in response to that. Likewise, I think there'll be an effort to accelerate the capital expenditures. Next slide, please. Yeah, the other thing that will probably mute investments is the weak business confidence and consumer outlook. Now, this slide's a bit dated, but I would not be surprised if we do a survey now, given what we're seeing in the health side, that it will continue to be show downward business and consumer confidence. The central bank, maybe finally, let me talk about central bank policy. I do agree with both speakers on inflation outlook, as well as on their read on interest rates. I think despite the increase in pressures in inflation, primarily from the supply side. Our central bank will continue to have an accommodative monetary policy. Incidentally, that kind of accommodation has not led to increase in banking because in loans, understandably, for all the reasons I've cited, banks are prudent and risk averse. So they have not much contribution to investment growth. Another slide, please. Next. This is just the external accounts. This came from the central bank. I also agree with the read of Fritz on the exchange rate on the current account, that the exchange rate will probably continue to be strong, partly as well driven by by both our surplus as well as some weakness in the dollar. But we also seeing some resiliency in the BPO earnings. Amazingly, how the BPO sector in the Philippines has been able to adjust to the working from home and so on. We've also seen remittances decline only very slightly, less than 1%, and may actually grow again this year. In part, I think, thanks to what Ray has mentioned about the very massive US stimulus package. We saw last year a big part of the reason that remittances did not decline is because of increasing remittances from the US. And I think some of the Filipino residents there, Philams, shared their bonanza from Trump by way of sending to their families here. So that also happened in Singapore and Germany, to other places which gave massive support to consumers. Finally, let me see. My last slide, please, before I say adieu. If you look at our forecast for Global Source, it's not too different from the forecast of Fritz. Let me just add that this was a forecast we did in early February before the surge. We are now in the process of looking at these numbers again, and likely will bring down our GDP growth rate. It won't probably be 5.5. If I have to name a number, it will be like 4%. But everything else pretty much the same. And finally, my last slide. There we go. The only function of economic forecasting is to make astrology look respectable. Okay. Let me end with that, and with pious hopes that I am wrong about my pessimism. I would love nothing more than to be very wrong about my pessimism. Thank you very much.
Thanks very much. Thanks very much, Romy.
Brilliant.
And we actually have a couple of questions. We actually have a question from Mr. Vic Lim. Mr. Vic Lim is asking, perhaps we should direct this to you, Mr. Ocampo. Fritz, you mentioned the growth in GDP, particularly the 14.5% growth in the second quarter, and a very optimistic GDP growth numbers. Well, Mr. Lim saying that the current 2-week lockdown, which will adversely affect the projections for the second quarter, will impact the full year projections. What's your response to this, Fritz?
Yeah, thank you very much, Vic, for your question. Actually, whenever anyone sees that number, we're all like jaded and skeptics, no? Where the hell did you get that number? But also, as the leaders of Philippine business, we all know that budgets are made on a year-on-year basis, no? And the reality is the second quarter of last year was the worst point, no? Wherein GDP contracted by 17%. So when you look at stock market behavior, the market is behaving based on sequential improvement. And that's why I highlighted earlier, don't be fooled and think that you will get back your 2019 net income and revenue stream. No, this is a sequential improvement in both GDP and earnings. Okay, and coming from a very deep hole, as Yupi would say, there's no way but up. Di ba, Romy, no? There's no way but up. The hole is so deep, no? So it's a year-on-year base effect. But as I mentioned earlier, if the government spends in the second quarter, then that will trigger the change in sentiment. And if the vaccines arrive in the second half, that will boost all of you guys' confidence, no, to at least accelerate the spending of your capex. No? So that's the framework here. I really hope that Romy is wrong. Romy is never wrong. No? Romy is never wrong. Yeah, but of course, the downside risk here is Romy's projection that if COVID cases really accelerate to 10,000, and as it is, many of our private hospitals have already reached full capacity, then there wouldn't be a choice but to call a timeout once again. No? As the Google data I showed you earlier, once you declare a lockdown again, then your mobility restrictions kick in, your spending actually collapses once again. So I agree with that scenario. So yeah, it's really driven by base effect and government.
And as well as the vaccine, I guess, which is
Yes.
what you were discussing earlier. And
Yes.
we also have a comment in the comment box that with the rate of vaccinations that we have in the country, it may take a while, and maybe Romy's projections. I see Romy smiling because of that risk.
Yeah.
That particular risk is it's a big risk. But can I move on to before I get Romy's response again? Can I move to some questions that are being directed to Mr. Faris? Ray, it was mentioned again. This question is coming from Vic Lim, and he's looking at the outlook for regional economies and investments. Because based on his own personal investments, his best bets were actually in Vietnam rather than in China. He mentions. Can I get your views on this one in terms of the regional economies, and perhaps you can also get your views on why the foreign investors are leaving the country, the Philippines. Mr. Faris?
Yeah, hi. Okay, so I mean, the first thing that I would say is that one of our core principles in investing at Credit Suisse is the belief that we really should have diversified portfolios rather than any particular single country or single sector or single stock bets. So we try to aim investors toward diversified portfolios that have positions across the region and across sectors in equities and in fixed income. On that front, we are constructive on the region. As I noted earlier, export growth should pick up. Asia is fundamentally geared via its export sector to cyclical recovery in the global economy. Historically, an export acceleration across the region has led to an acceleration in earnings growth. So that all leaves us pretty constructive. The way that we think about this is that we want to be diversified around the region or across markets and sectors. We think that China has a lot of opportunity that still exists in it by virtue of its size, its still rapid growth rate, and its government policy that is driving towards some pretty aggressive objectives in the ESG space, in really what we call sustainable China, which is the government's objectives toward reducing carbon emissions that require really a wholesale restructuring of China's energy sector, moving towards solar and gas and wind power away from coal, with very strong government commitment and support for those sectors. So I think the answer to the question is, I don't want to get into any particular country as likely to be the best bet in the region. I would rather focus on the fact that the region as a whole should benefit from this cyclical recovery driven by the United States, and that portfolios that have good diversification around the region in both equities and fixed income are probably the best way to play that.
And can we have your view on the Philippine equity market?
The Philippines is a market that I don't personally cover, I'm afraid.
Okay.
But I would, just listening to what the two other speakers have said, I think they're absolutely right that what's crucial here is the vaccine rollout and control of COVID. And that once that takes place, the Philippines will also benefit quite powerfully from this cyclical recovery. The Philippines does have an export gearing. It has an exports, the services sector has a substantial export component that will probably benefit from regional growth and global growth. And ultimately, when both the Philippines and developed markets have attained a high enough level of vaccination, essentially herd immunity, there should be a boost to the Philippines tourism sector as well. That's more likely to come next year than this year, but it is nonetheless in prospect.
Good, thank you. You did mention something about the European market, and you were very keen about the U.S. market as well as the Asian market. But you were not keen. You were not too keen about. You seem to be very keen about the European market in the sense that you mentioned that it's supporting rather than stimulating the economy. That seems to be the policy in the Eurozone.
Well, my point there was about fiscal policy in the United States being more, if you will, proactive in attempting to actually raise GDP growth and push the US economy back to trend growth rates, trend growth levels as soon as possible. Europe's fiscal policy has been aimed at supporting its economy, preventing it from having a larger economic contraction. A lot of that's been aimed at supporting labor markets, but in aggregate, that stimulus is not nearly as large as in the United States. So Europe is not going to recover back to trend nearly as quickly as the United States. The other key variable in Europe, of course, is the vaccination program. And there, the United States has gone from, you might argue, doing a poor job of managing COVID in 2020 to now doing a very good job of managing its vaccination program. The United States is vaccinating over 3 million people a day. Something like 20% of the population has now been vaccinated. And we look like we should be at herd immunity by the late third quarter, early fourth quarter of this year. In contrast, Europe has sort of stumbled both in getting vaccine supply and now across Europe distributing vaccines. Most countries actually have more vaccine supply than they are distributing on a daily basis. And of course, some of the problems, some of the concerns recently about one of the vaccine suppliers may be affecting the willingness of Europe's population to take that particular vaccine. I think it's just a matter of time, measured probably in months rather than quarters, that Europe recovers momentum on this case, in this area and starts seeing an acceleration in vaccination. So I'd be more constructive about the second half of the year for Europe in terms of GDP growth and recovery than the next couple of months.
Okay. Now, I guess you were referring to the AstraZeneca questions, right?
That's been a lot of the problem, yes.
Okay. And while we still have you, the US Fed recently announced a 2% inflation target. What does this make of bonds and stocks in the future? Can we have your view on this one?
Well, the Fed's introduced a new policy regime, which is average inflation targeting. And so what the Fed has said is that unlike in the past, in which the Fed has a forecast or has an estimate for potential, output in the United States, and in particular, an unemployment rate below which inflation will begin to rise. And given those forecasts, the Fed tries to begin tightening on a preemptive basis. The Fed is now in a regime where the Fed is going to be much more reactive. It wants inflation, as it measures it, core personal consumption expenditure inflation, to rise above its target of 2% for a period of time, because we've been running below 2% for several years. The Fed wants inflation to average 2%. That means when inflation is below 2%, it's going to have to go to above 2% for a period of time and stay there before the Fed is really justified in tightening policy. Linked to that, the Fed is no longer applying a sort of strict guideline from a NAIRU, a non-accelerating inflation unemployment rate. Rather, the Fed is going to allow the economy to sort of define for it via the data what that rate is. It's going to try to target as tight a labor market, as low an unemployment rate as possible, as long as that is consistent with inflation not being too high. So we don't expect the Fed to tighten, to begin raising its Fed funds rate until sometime in 2023. The market has pulled forward pricing for the Fed from what was 2024 to the beginning of 2023. There are now approximately 4 hikes that are priced in. Sorry, I apologize, about 3 hikes priced in to 2023, which is pretty aggressive. And linked to that, the US yield curve has steepened quite a bit. We think there's a good chance that the curve could steepen further, with US 10-year yields rising easily to 2% by the end of the year. The distribution of risk is that they could be higher than that, given the strength of the US recovery. But we view that as a bear steepening in the US curve, the longer dated yields rising faster than front dated yields, as a reflection of strength in the economy. Historically, when you've had these bear steepenings driven by growth, they haven't really been that damaging to risky assets. The thing that really tends to hurt risky assets, equities and credit, is when corporate earnings deteriorate. That's really ultimately what is most toxic for equity markets and for bond markets. Right now, earnings estimates in the United States are rising and rising very rapidly, as they should, given the outlook for strong growth. We think that probably continues at least through this year.
Okay, thank you. Thank you. So you're very optimistic about growth in those areas. Going back to the Philippines, we noticed that in one of the slides of Mr. Ocampo, he mentioned that SM actually, or it's actually SM Investments, that's the most traded stock in the country at this point. I also realized that the SM actually has a high PE relative to the other conglomerates. Perhaps John Ong, can you share with us perhaps the secret sauce of SM, and I guess SM Prime, I guess, what's keeping that stock up?
Well, looking at the commitments that we've made, as well including the capex, I suppose that's the key item there. The commitment continues to be there, but with prudence. No, we look at in terms of capex, we have indicated that we will continue to support the capex plans for year 2021, albeit the decrease in year 2020, but then. I think another is the secret sauce really is the support that we provide our stakeholders. No, it's a broad term, but basically the support that we provided our contractors as well as the tenants. No, more so the tenants, because as you would indicate, as we disclose, the tenant support has been significant in terms of what we provided last year 2020, and depending on the conditions of year 2021, we will continue the level of support to contractors, the tenants, and more so the employees and the suppliers. No, that I believe is a significant one. No, the continued support is necessary, not only for the industry, the real estate industry, but economy in general. No, but because it continues to provide employment for our own employees, but more so for our contractors and suppliers and the service industries, no, that we are working with. So with continued employment, that comes the continued consumption and the public consumption. Although we have to really put such emphasis on the 73%, as mentioned by Fritz, because that 73% public consumption is based on the assumption that there's continued employment. But then if you talk of employment, that means continued infrastructure, continued capex coming from the government and the private industries. No? So with those items in the key assumptions, then I think that should hold true for year 2021. But then yes, we do really have to put such emphasis on the restrictions, no? Because as I mentioned earlier, when we look at the restrictions, areas where we have MGCQ or lesser restriction, that they provided far better operational performance results given the less restrictions. No? And as mentioned also by Fritz, the employment and the industries had shifted from a particular geographic area in the country towards the Visayas and Mindanao. And we've seen that movement had also supported our growth in the provincial malls, no? And even to the extent our residential projects in the provincial malls. The secret sauce is basically working together and coming up with integrated developments for us. No? So it's an integrated development of having the malls and the residential projects together and properly supported by, as we mentioned, by the industry, the economy, and the employments. No? This goes hand in hand. Otherwise, the challenge really is how we can achieve the budget for year 2021, and that is really hinged on vaccination, the restrictions, and its implications on the economic growth. No, thank you.
Good, thank you very much. We actually still have a couple of questions, but unfortunately we've run out of time. So at this point, can I just request if there are any, if our two speakers have any other things that they can share with us? Can I start with Fritz?
Well, the only thing I can say is we're still in a crisis, Ned, and we cannot rely purely on government. As the business leaders, each one of us has a role to play. Either number one, in creating jobs anew, in implementing your capex expansion, as I showed. At least the numbers are there. We just have to execute. The market is very liquid. There wouldn't be any problems in accessing financing. Of course, BDO is always there because we find ways. That's the first point. In terms of the vaccine rollout, once again, each one of you might have to source vaccines for your own employees. We cannot just wait around and wait for the vaccines to arrive. So that's the second point. And I think in terms of the learnings here, Ned, none of us have talked about it, but I think what happened in 2020 highlights the underspending of the Philippines in our public health system. Both the public sector and the private sector failed to infuse capital or investments. No? And we're seeing this with our hospitals easily overwhelmed as the number of cases rise. And I hope that more conglomerates or more companies would look at the front end and back end of the public healthcare system. Thank you.
Thank you, Fritz. And Ray, Mr. Ferris?
Hi, I'm sorry because Ray had to go to
okay, that's fine.
another appointment because he has like a speaking engagement that he has to run. But he says thanks for the opportunity for giving us from Credit Suisse, and then we look forward to participating again in the next PHENEX event. And please feel free to reach out to us for any economic outlook or even the investment themes that we have for Credit Suisse. Thank you very much on behalf of Credit Suisse AG Singapore. Thank you, sir.
Thank you, Anne. In which case, I would like to call on our liaison director for our committee, Mr. Omar Cruz, for the closing remarks. Omar.
Thank you, Ned, and thank you to the more than 130 participants to this online briefing. And thanks, of course, to our speakers, Mr. Ray Faris and Fritz Ocampo, and our panelists, Mr. John Ong and Romy Bernardo. I think all of the insights were very interesting, but I think there were a number of learnings that we have obtained, from the experience of other countries who have gone through the pandemic cycle, so to speak, and have gone out of it and have started to recover at different paces. Obviously, we can learn from all of that. And I think one thing that we have picked up is that everything now is a function of execution, administration of the vaccination rollout, and that would dictate the pace, of our business opening and recovery. And I think there's so much to look at for. I guess this is only our first economic briefing. I think we can organize another one in the second half, and by then I think we could get a good update in terms of how we are rolling out on the sort of the vaccine curve and how business is reopening and responding. So again, thank you all. Thank you, Ned. Thank you to Chair Paul and Vice Chair Edith for organizing this briefing. And we look forward to the next one for the update on, again, the business and economic developments as we proceed with the vaccine rollout. Thank you.
Thank you, Omar. And with that, we bring to a close this economic briefing, and we look forward to seeing you in our future events. Good afternoon and bye.
Thank you.
Thank you all.
Thank you.